In the first 4 chapters of our course, we really focused on the service type business. You probably noticed that our main revenue account was service revenue. We were accounting for various service businesses. In fact, I think we used like a tax return service as an example. In chapter 5 now, we're moving into merchandising operations. You're familiar with them. All of these businesses that have merchandise, they sell products. They're called merchandising businesses. Now, I've got this color coded for you. I don't. It's really the way business works. In fact, I know everyone's heard of the JFK assassination in Dallas back in, I believe it was 1963. Well, he was on his way to Dallas to see the market, a brand new, and it's still there, 6-story building, and the market sells products to all kinds of businesses all over the southwest part of the U.S. from their Dallas location, and it still exists, as I said. So what we've got here is understanding these as merchandising businesses. What happens is you've got it, and I've got it in green for you here, WIM, a wholesaler, importer, or manufacturer. This could be like Sony making TVs. This could be a big importer up on the east or west coast somewhere. But what they do is they sell products to stores, the stores that you and I walk into and buy merchandise from. Okay, so these big time wholesalers or manufacturers sell merchandise to the stores, and these are retail merchandising stores. These stores, they buy from this wholesaler, and then they turn around and sell to you and I. Now I know this is hard to see on the screen right now. I probably should have used white letters uh, for the letters within my colored zone here, but these are retail customers and they buy from retail stores. So what you've got here is you've got wholesalers selling to the retail businesses. There's transactions going back and forth between these two. Sometimes a store will buy something uh, from a manufacturer and want to return it, send it back. Okay. The store, of course, is wanting to sell to you and I, customers, but sometimes you go into Lowe's or Home Depot and, well, you return something back to the store. All of these things, these sales between, these transactions between buying and selling between these various groups here, are what we're going to be focusing on in this chapter. So let's look at the basics here. And it's probably a good idea. We've got lots of debits and credits in this chapter. You probably should go back to chapter 2, the chapter 1 2 text. I believe it was page 10 where we had the rules of debits and credits. Make sure you keep that handy, probably throughout the course. So what we're saying right here is the retail store, okay, they buy products from, as I said, the manufacturer. Okay, now when they buy, as you read here, in their inventory, these merchandising businesses in yellow, it's merchandise inventory to them. Merchandise inventory is what they purchased for sale to you and I. It's an asset account. You debit, the account is debited to increase the store's merchandise inventory, and they either pay cash either goes down with a credit, or accounts payable is credited to increase the debt, the amount due. But this is the basic transaction. Merchandise inventory up, typically accounts payable up. Most of them have accounts. Okay, now when they sell products, when the store sells products to you and I, or when the manufacturer sells products to the store, we're going to use a sales type journal entry, and there's two pieces to it, two parts to it, as it says here. The first thing you have to do is record the sale. Notice it's sales revenue. We've got a new revenue account. We'll see it on the chart of accounts on the next page. It's a new revenue account. When you sell a product, it's called sales revenue. So in this case, we walk in a customer name, for example, if here, cash or accounts receivable. If the customer pays cash, you're going to debit cash. If the customer has an account and you make a sale to them on account, then accounts receivable will be debited, and you'll include the customer's name who owes the company the money. Sales revenue, that new revenue account, will be credited and be increased. So typically what happens when the sale is made, typically accounts receivable goes up and sales revenue goes up. The second piece to that is to record the cost of the goods sold. In this chapter, we'll explore a little bit further in a future chapter, but in this chapter we're using perpetual inventory, which means every time a product is sold, accounting removes it from inventory. The second part of this entry is to remove it, credit merchandise inventory at whatever the company paid, whatever price the company paid for that particular piece of merchandise that was sold to the customer, remove it from inventory, and debit cost of goods sold. Okay, that's a new expense account type that we have. It's a huge number, typically one of the biggest expenses a company is going to have, cost of the goods that were sold. What did the company pay for this item that was sold? It's recorded right here. Here's the sale. Here's the cost of that sale. We move on to page 2. You'll see we've got several new accounts. These are new accounts for us. Sales revenue, sales returns and allowances. When a customer returns an item, it's called a sales return. We're going to see we're also going to use the allowances feature in a few pages. Sales discount. If we're interested in getting paid fast, if we want to get paid fast, we'll include some terms on the invoice, and we'll give the purchaser an incentive to pay quickly and save a little money. It'll be recorded in the sales discounts account. Cost of goods sold, delivery expense. Products are getting delivered all the time. You know that. Amazon constantly shipping. Here's gross profit. Okay, look at this. It's not an account, it's a label. Now, in addition to these income statement accounts, we've got some balance sheet accounts. As I mentioned, the merchandise inventory, the cost, remember the cost principle from the first chapter. The cost principle, record that merchandise at cost. Going to sit on the shelf until a customer comes in and purchases it. Sales tax payable. If the business sells to the retail customer and collects sales tax, we're going to see the minute they get their hands on that, that's a payable. They don't get to keep that money. It's owed to the state comptroller. So let's take a look. We're upgrading our chart of accounts. I hope you've got a hard copy of this in front of you. And you'll see what we've got is we've got new accounts in bold. Merchandise inventory, asset account. These assets, we'll continue to add assets throughout the course. Here's liabilities. There's that new one, sales tax payable. Look at this. On the revenue side, here's that big one, sales revenue. We're going to use every time we sell a product. And then we've got these special instances, sales returns, customer bringing something back, sales discounts, have a customer pay us fast, save a little money. We'll record what it cost us to do that in the sales discounts account. There's that cost of goods sold and delivery expense. These are the new accounts that we've added to our chart of accounts, and they make up the typical chart of accounts for a merchandising business. On page 3, we compare the first several chapters, the first 4 chapters. For a service business, our income statement, we had service revenue, and then we subtracted all the operating expenses to arrive at net income. All right, we saw that on the income statement in chapter 1. Now, merchandising business, look how it's different and look how it's similar. The bottom half of this, it's very similar. The same concept. On the income statement, it's going to list all these operating expenses and going to arrive at net income. But look at the upper part. Sales revenue minus sales discounts minus sales returns and allowances is equal to net sales minus cost of goods sold, and now gross profit, that label. If you take all the sales minus the discounts that are allowed to customers and subtract what that merchandise costs the store that's selling that merchandise, that is the gross profit. The gross profit. From that gross profit, you better make a good sized gross profit selling those products, because yes, you've still got all of these operating expenses. Now we've got some new terms, call them buzzwords, whatever, new business terms. They have a special meaning in this chapter and in business. Purchase discount. Look at this. Purchase discount reduces. That's when you pay fast. You're buying something, for example, for your store, and you pay fast, save some money. Well, guess what? That reduces your cost of that inventory. So a purchase discount, say we've got a store here in San Antonio in 1604, and we purchase from the market up in Dallas. You'll see, if we pay them fast, we can get it for a little bit less, and it will reduce the cost of that inventory that we purchased. Credit terms, the credit terms are shown on the invoice. An invoice is always going to be generated in a business transaction, and what it's going to list is all the particulars, all of the facts. And here, if you look at it carefully, oh, look at this. These are an example of credit terms. 2/10, net 30. This is, take a 2% discount. If you pay us fast, pay us within 10 days, you can take 2% off of that invoice. But if you don't, if you pay on the 11th day up to the 30th day, no problem. Just pay the full amount. You won't be able to, you're not going to be able to save 2%. Okay, and of course, if it's end of month, it'll be shown this way. Typically, it's usually more times than not number of days versus the end of the month, but they both appear. The invoice shows all the details, including these credit terms. A purchase return. A purchase return. It is exactly a purchase return. Oh, we've purchased merchandise. We've got a store. Maybe a couch comes in and we go, well, we don't, the couch doesn't look quite right, and we bought it from the market up in Dallas. Okay, well, we'll return it. Purchase return. That's exactly right. Purchase return. So these terms have special meaning for us. on the page 4. These trade discounts here, you cannot get into the market up in Dallas unless you have unless you're a buyer for a big store like Dillard's or Macy's, or you can have your own store. Now, it can't just be out of a spare bedroom in your house or apartment. It has to be a retail storefront. If you've got that, then you can get into the market up there in Dallas. And I've been in. And I'll tell you what happens is you've got buyers walking around with salespeople walking close behind them, and they're looking at all this merchandise. They're maybe buying 30 couches at a time or 50 tables at a time. And the big question for the buyer is, well, what's the retail price of something? In this example here, it's $1,000. Maybe it's $1,000 couch. And the buyer turns around to the salesperson and says, well, what's our trade discount? How much trade? We're in the trade. We're not buying this for ourselves. We're buying this to stock our showroom down in San Antonio, and we're going to sell that to the customer for $1,000. So now how much do we have to pay for it? We're buying 10 or 15 at a time. And so in this case, it's an example of a 40% trade discount. 40% off, $400 off means we would pay $600 for it. The perpetual inventory system used in this chapter, every time we sell something or purchase something, accounting is going to put it into the merchandise inventory account because we want the merchandise inventory account in our financial records on our books to try to constantly reflect, perpetually, constantly show the actual inventory we have in merchandise. Freight in, near the end of this chapter, we're going to get into freight in a more detailed fashion. But right now we can see the freight in. As a basic rule, you can always say that the cost of shipping, whatever it takes to get something, whatever we buy from Dallas, whatever it takes to get that delivered to us right here in San Antonio, okay, that cost of that freight is going to be added to the merchandise that we purchased. Sometimes we'll see this was the FOB shipping point. Shipping point means on their back dock. If we purchase something FOB shipping point and it's the business up in Dallas, they're just going to push it out on the back loading dock in Dallas. It's up to us, the buyer. We're going to have to get that down here to San Antonio. It's our responsibility. We're going to pay for it one way or another. Or the seller, maybe the market up in Dallas, they can take responsibility for getting it to us. It's important. Freight can be very expensive. FOB destination, this is free on board. So this says whatever price we're paying for it, you got to get it delivered to us down here in San Antonio, the destination. This one, FOB shipping point, the back dock. Never going to be able to save any money on freight when it comes to quick payment. Don't make that mistake. Freight out, if we were to sell something FOB destination, look at this. That's the only time delivery expense is ever used. Delivery expense is when we've sold something FOB destination and we've got responsibility for getting it delivered to the customer. Okay, now those are the basics. Not surprising, in this chapter where we're going to learn what are the accounting entries that accounting needs to make to record these transactions. And if you flip ahead, and maybe you should, are on page 4 right now, sales related transactions. If you were to flip over to page 8, you'll notice it's purchase related transactions. I want to make this point to you now that because these are typically what we're doing here, it's the market up in Dallas selling to our store right here in San Antonio. That's going to be our focus, the buying and selling between these two. So now every time there's a sale up in Dallas, well, guess what? There's an accountant working for the store down here in San Antonio, and for the store, it's a purchase. If you're working for the seller up in Dallas, it's going to be a sales related transaction. But the other side of that is going to be the purchase transaction. You're going to notice we've got, as you've seen here, we've got 5 different situations. I call them S1 through S5. One of these 5 transactions, one of these 5 entries will be made in connection with sales related transactions. And if you looked at page 8, we've got purchase 1, 2, 3, 4, 5. There's the other side of the coin for each one of these. So we're going to go through each of these, but this is sort of an overview, a summary. The basic one, the market up in Dallas sells merchandise to our store down here in San Antonio. What do they do up at the store in Dallas? Well, they record an accounts receivable from our company down here in San Antonio, and they record the cost of the goods sold. That's that first entry we looked at over on page 1. Record the sale and record the cost of goods sold. They'll do that every time. It's the S1 transaction to record the sale and the cost of goods sold. Now look at this, S2, if, only if some of the merchandise is returned do we use the S2. What happens? The merchandise gets sent back up to Dallas. In Dallas, they put it back into inventory, and they adjust the amount due from the store. Hello, the store is not going to pay for that merchandise that's been returned. This happens every day. S3 will use that journal entry coming up on the next page or the page after. If there was some damage, it happens every day. If there's some damages that occur, look at this. Many times the store down here in San Antonio will say, listen, we've got some goods that were damaged, but we're going to find that we're not going to return them. If we return them, we'll use an S2. If we just call them up and say, listen, there's a scratch or something, you need to back off a few $100s on this merchandise, then that's when we would use this. Now, these last 2 have to do with the payment coming in. Payment from the store. One way or another, the store down in San Antonio is going to pay the market. If the store, received quickly, if the payment from the store is quickly, because up at the market they offered some credit terms, hey, save 2% if you pay quickly, then we'll use an S4. If the store does not pay quickly, then the accountants up at the market, if it just comes in regular, they're going to use the S5. They didn't meet the deadline. They're not going to have saved any money. We'll use the S5. On to page 5. The market up in Dallas makes a sale. How do the accountants up in Dallas make the entry? What entry do they make, and why do they make it? In this case, the market has sold 100 big screen TVs, to the San Antonio store. It cost them up in Dallas $300 each. 100 TVs, that's $30,000 in inventory cost up there in Dallas at that market. Maybe they bought it directly from Sony, who knows? But they paid 30 grand for those 100 TVs. Now, only they know what they paid. But what we know is that the store sells these 100 TVs to us right here in San Antonio. Now, what do we pay for them? $500 a piece. Of course, we're not going to get it for $300. That's what the market paid for it, buying it from Sony. They're going to be sold for $500. The store will never know, exactly what the market paid for those. They won't know they paid $300. We feel like we're getting a good deal in San Antonio, getting them for $500. So $500 times a $50,000 invoice. And oh, look, there's credit terms, 3/10, net 30. So this is the S1 journal entry. It's two parts. Record accounts receivable from Longhorn. That'll be our electronics company here in San Antonio. Accounts receivable, Longhorn down in San Antonio. They owe $50,000, and the market credit sales revenue up. More accounts receivable, more sales revenue. This is the accountant for the market. Part 2 of that, the accountant is going to record the cost of the goods sold. Here's the $30,000. That's their cost of the inventory that was sold. Nice. They sold it for $50,000. Well, it only cost them $30,000. Debit cost of goods sold to increase it. Credit merchandise inventory to decrease the merchandise balance. Now we're going to go down through those. That was the sale. Now, what happens if the payment comes in before the deadline? Remember, there were terms that were offered. They offered, looking back to the top of the page, 3% discount if paid within 10 days. Well, it was sold on November the 1st, and look at this, November the 8th, 7 days later, within the 10 period, the store cuts a check, and they send that check up to Dallas. When Dallas gets it, they're going to open that up, and the first thing they're going to think is, oh, we've been shorted. We were owed $50,000. No, terms were offered. Remember, look at the invoice, 3% discount if paid within 10 days, and we can see that the cash, the amount of check that the store is going to write, they're only going to cut a check for $48,500. They're saving $1,500 by paying early, paying fast. And that's recorded as a sales discount. There's the 3% discount right there. They're saving $1,500. Now you know that debits and credits in total have to equal for each transaction. And that's what we've got here. Cash is going up in Dallas. Sales discount, $1,500. Where's that recorded? Look at that new updated income statement. Going to be reported up there in the revenue accounts. And there's the accounts receivable. Longhorn, there's the $50,000. The company up in Dallas recorded $50,000 due from them. And this is a payment in full, that $50,000, decreasing accounts receivable. That's all they're ever going to get from Longhorn. They got the cash and recorded the sales discount. Now that's if they paid fast on November the 8th. If the check didn't come in so fast, in fact, the check didn't come in till November 27th, long after the 10 days, well, that store is going to have to write a check for $50,000 and send it up to Dallas because they didn't get it paid within the 10 days. On the 27th, here's the journal entry. This was number 4. Go back and read the definition. If they pay fast, you'll use the S4. If they pay just regular, no problem. This is how you're going to record it. The check is going to come in for $50,000, debit cash to increase it, and credit accounts receivable Longhorn. Now let's throw in a couple additional wrinkles. Customers are always returning merchandise. Stores in San Antonio, when they buy something, many times they'll return something up to Dallas. Well, you and I, when we buy something from Lowe's or Home Depot, well, we might return it as well. What we're looking at here, but wait, what if there was merchandise returned from the customer? This is before anything is paid. What if there's a sale? In this case, we did. Remember those 100 TVs? Now, 2 of those TVs are going to be returned. Our quality control inspector here in San Antonio didn't like them. They were sent back to Dallas Remember, $500 was the sales price. They're getting 2 of those TVs back. What should we do? How should that be recorded? Here's the S2 journal entry. 2 parts. Number 1, look what we've got here. Sales returns. This is a sales return. The accountants up in Dallas record this $1,000 as a sales return. There's $1,000 worth of sales being returned. We credit accounts receivable, reducing. Longhorn down in San Antonio is not going to be paying for those TVs. They're returning them. Reduce their accounts receivable. And the merchandise at this point is put back into their inventory up in Dallas. Remember, they only paid $300 for those. $600 will go back in for the 2 TVs and reduce the cost of goods sold. Those 2 TVs were not sold. Now, at some point, we know if this is damaged merchandise inventory, something will have to be done. But at this moment, we're just getting it back into their merchandise inventory back up in Dallas. So let's assume that there was that return of merchandise. After it was sent back, notice it was sent back on November the 3rd, then the store in San Antonio gets out their checkbook and they cut a check. Now, how much are they going to cut that check for? Well, it's not going to be for $50,000. It's going to be for $50,000 minus the $1,000 that they, remember the 2 TVs they returned, and also they're going to take advantage of the discount because they're paying on the 8th. So in this case, we've got to consider a few things here. The $50,000 minus the $1,000 in return. Look at the discount. You don't get to take the 3% discount if you pay fast on the full $50,000. No, it's only what you're going to wind up purchasing. So the discount is $1,470. So how is that recorded up in Dallas? Well, they're not getting $50,000. They're not even getting $49,000. What they're getting up in Dallas is $47,530. They've got a $1,470 cost. This sales discount is going to reduce the net sales revenue, and accounts receivable. They're paid in full. This $1,000 right here, return, and then this $59,000. Okay, well that completely wipes out the $50,000 that was due from accounts receivable from Longhorn. So what happens? This was if they paid fast. What if there was something returned? Fine, but the payment was not made within the 10 days. What happens then? Well, that check amount's going to be for $49,000. Okay, the $50,000 minus the $1,000. Well, after the discount period, don't have to calculate any sales discount. In Dallas, the cash is going up by $49,000, and the accounts receivable from Longhorn is going down by $49,000. On page 7, oh boy, look, it even gets a little more complicated for us. What if there were returned TVs? Remember those 2 that were damaged so much we sent them back? But also there were some TVs that just had some scratches on them that we didn't want to send back, but we did call Dallas and say, listen, they're scratched up. You need to back off something. Back off a little sales price. Give us a better deal since they're scratched. So what we've got here, this first one, there's been a sales return. Okay, so let's assume we had this sales return. We looked at that. And also, look at this. We had some scratches on some other TVs, 3 other TVs. We called them up, and it was negotiated. Okay, we'll take $400 off. So in Dallas, the accountants reduced the accounts receivable from Longhorn for $400, and this is what's called an allowance. This is not a sales return. They go into the same account. They're sales returns, as we saw up above, the $1,000. This is the allowances part. Okay, let's give them an allowance, a damage allowance. Those TVs were scratched. We don't want them back up in Dallas, so we just have this allowance. After that happens, what do we have? On November 8th, if they pay fast, what's going to happen? Well, follow this. What's the store going to do down in San Antonio? They're going to $50,000 purchase, but then they sent back $1,000 in returns. And remember the $400 damage allowance? Okay. And we're paying fast, so we're going to get a discount. So follow this logic right here. Okay, let's this. 50,000 minus this, and minus that. The check amount coming into Dallas, $47,152. The sales discount, notice this is $1,400 less than the $50,000. This is minus the $1,000 and minus the $400. Earn the sales discount at 3%, and accounts receivable Longhorn. We know the way this works. Accounts receivable Longhorn goes down by $1,000 here for the return, down by $400 because of the allowance, and then down by $48,600 due to the payment. If the San Antonio store waits till after the deadline, waits till November 24th to pay for the merchandise, what's going to happen? $50,000 minus the return, minus the damage allowance, but they're not going to be earning any discounts. They didn't pay it within the discount period. Cash in Dallas will go up $48,600. Accounts receivable from Longhorn will go down $48,600. Now the next video is going to start with the purchase transactions. I want you, as I go through those purchase transactions in the next video, look back, keep these first pages handy, because we'll come back and I'll show you on several occasions what one side of the coin looks like and then the other side of the coin.